Well, welcome. Got about a minute before the hour. We'll give everybody about another 2 minutes before we get started. Appreciate everybody joining here today. Welcome, welcome. We were just talking before we went live here that there is somehow statistically, it doesn't seem possible, but it is a 101% chance that whatever asset we're doing a webinar on usually plummets from the moment we send out the first email to the time we do the webinar, almost in a laughing sort of way. So I mentioned we ought to set up an internal hedge fund just to short whatever asset we are going to do a webinar on. But somehow, some way, crypto has, as volatile as it has been, has obviously held up very, very well since we had this idea. We've been getting a lot of conversations around this. So, well, I've got 12:01, so let's go ahead and get started. Appreciate everybody's time today. So a couple housekeeping notes as we sort of start. I probably should wait on housekeeping because people that come in 5 minutes late always ask the same questions in the Q&A. But anyway, we do not send out the slides directly. However, we will do that indirectly next week, and would very much encourage any of your questions and answers in the Q&A. I think we've actually even turned off our chat feature, so that was becoming a little bit cumbersome. So at any point now or any point during the session, just go ahead and include your questions there. We'll do our best. I'll do my best, sort of be replying sort of in real time. We'll ask anything of the presenters, Ryan and Paul, sort of as appropriate. And then for whatever reason, if we are just flooded with great questions, which I'm sure will be the case, we mush all the questions from today. We'll include all the ones from Thursday, and then we'll include the Q&A in a Word doc table when we actually do the full posting of the webinar next week. So I should know how many of these webinars we've done. I think this is real close to our 60th. We were supposed to do this for about 3 to 4 months during the short-term COVID situation, and here we are many years later. So I always say life is momentum, for better or worse. And I guess once you start, with 54, you kind of have to do the 55th, and here we are. So I just continue to go. So we're going to talk about crypto-funded charitable remainder trusts and gift annuities. Yes, you can do that. And we are doing these as well. So this is sort of less than theoretical. And so we got Ryan Raffin, my partner, heads up all of our non-cash assets. Paul, sort of vice president, does a lot in our real estate space, as well as in particular life income gifts funded with any kind of non-cash gift, and leads our CRT space. So obviously be good to have him on too. So Ryan, if you want to maybe just go to the next one, I'll hit quite quickly our overview of the firm here. I'll keep it pretty short. And so our mission since day one, back in 2003, is to help make charitable gifts happen that otherwise wouldn't, like crypto. And so not only like crypto as outright gifts, obviously we're talking about crypto from a life income perspective. Unless I'm missing something big, which I certainly could be, I have not seen any, I don't think, maybe Ryan or Paul have, but any sort of marketing or website or case study material around crypto for CRTs or for CGAs coming from the charity. Certainly we're seeing some of that in the professional advisor space, but not from charity. So that's what it gets to the point of, here's another type of asset that could otherwise be very conducive for charitable gifts, has some risks around it, which will be discussed today, but that's literally why we exist. And so sort of going top right over, we have Emergency Assistance Fund Administration. We do this now, it's over 14 million employees. I think it's a little bit older here. 14 million employees that we now cover, and that's a global charity emergency assistance foundation that I founded back in 2010. We do a lot of this type of work, professional advisor, CE, board, staff, donors, nonprofits, speeches. Do maybe 6 to 80 of those a year, primarily around these types of topics more generally. Charitable appraisals. So I have been flooded in the crypto space in a pretty good way on doing cryptocurrency qualified appraisals. Maybe have done, guessing, 250 this year-ish. Got to be pretty close to that. I also do life insurance. We have two people that do business appraisals, again, qualified business appraisals for any kind of charitable donation. So our sort of tagline is, if you can give it to charity, we can appraise it. We do not do local real estate, and somebody stumped us with a horse. So we don't do horses. So any livestock we don't do, but everything else, you can see the list there. We have 5 appraisers just doing charitable appraisals. Then gift annuities. We're going to talk about that obviously today. We do sort of 2 legs of this service. One is where charities are managing their own pools, or the so-called sort of self-insured portfolio model, that we do risk assessments, actuarial assessments, concentration of risk, potential reinsurance design on very large ones, and so on, for those types of pools, usually $5 million or more in assets. Do roughly 2 of those per month, and have been doing that since 2003. So we've done a couple hundred pools at least at this point. And then for those charities that may say, you know what, we don't want to issue in a particular state. We don't want to do gift annuities at all. We never want to start. We don't want to keep doing them. We don't want to do them for crypto or for real estate, etc. Then we have our National Gift Annuity Foundation. So that's an outsourced national platform. It's its own distinct public charity. And guess what it does? Gift annuities. That's it. So it only does gift annuities. This is definitely outdated in a pretty surprising way. I think this might be a year old, maybe, but we're still in all 50 states. So that's very important. We still have 100% of the residuum that's granted back to the charity or charities the donor was trying to give to in the first place. So we don't manage anything liquid. But where this is old is we're closing in on 1,100 contracts. We may have already passed that, but we're real close, 1,100 contracts. And it's about 95 million in assets. So just in a year, it's gone up a couple hundred contracts. We're doing roughly 1 per day in terms of gift annuities. 100% of those 1,100 gift annuities were referred in by other charities that did not want to do a particular gift annuity. So we're only getting referrals from other charities that don't want to say no to a good donor wishing to do a gift annuity. And rather than them saying no, they're referring it over to National Gift Annuity Foundation. We manage all the stuff, and then 100% of the residuum is then granted back. Similarly, always a fun word to say, we do the same thing with non-cash assets. So we have the Decami Asset Trust, the Decami Foundation, 2 national donor advised funds only doing non-cash or complex asset donation, management, and liquidation. So now I think it's got 4 billion. It's actually over 5 billion now. $5 billion of non-cash assets that were initially declined. Same thing. We only get referrals from other charities that have great donors with these types of assets wanting to do great things. Otherwise, they would say no. Maybe there's some legal issues. Maybe it's a super quick turnaround time. We just got one yesterday. We're supposed to finish like a $14 million. Let's see if we can do it. Real estate, hopefully today. Crypto, S Corp, any type of asset that the donor may be trying to make as a donation, we get roughly 8 to 10 of these referrals a day on the non-cash side, and also, strikingly similar, do roughly 1 per day completed. So we do 1 gift annuity per day on average, 1 non-cash donation on average. And you can see there, the average donation is around, you can see there it's about 5 million. It's come down just a little bit. So it's around that 3.5 to 4 million is the average donation. These are all outright gifts. We also have Charitable Remainder Trusts. That's what Paul will be talking about as well. So with that, that's sort of us. It all gets back to good donor, good assets, trying to do good things. Don't say no. So we have this entire platform to manage the risk, maximize the actual net grants out. Okay, I'll sort of pass it over, I think, to you, Ryan. Is that right?
Yeah. I'll take the next couple slides here and then do a bit of an intro and primer on crypto generally. And anyone who's watched these webinars knows that we always have this summary of the Decami. That's the DAF component of our service line. The Decami activity from the prior year. And so the item that we want to call out here, and that I should have highlighted, I've done that before when it's relevant to the month's webinar, is the cryptocurrency line item. Last year, 2024, big year for the crypto markets. correspondingly, we saw a huge uptick in crypto donations, 72, which I think was literally double the prior best year, which was 2021. Over 100 million in crypto gifts, and that's holding aside some things that are sort of crypto related, like venture funds that have crypto investments. Those are not even in the cryptocurrency category. Those are in the business interests. So very, very big year in 2024 in the crypto space, and that has continued, as we will discuss in a little bit. And then just to emphasize Brian's point, these are all gifts, whether cryptocurrency or real estate or business interests or otherwise, these are all gifts that otherwise would not have happened. So that is the whole point for Decamai, for Charitable Solutions, is to facilitate these gifts where the end charity may not have been able to do them directly. We make them happen, and you can see here, these are real dollars, a ton of money that otherwise would not have gone to charities. So crypto in particular, of course, is the focus today. A quick agenda here. I'll handle the crypto primer and talk about sort of basic crypto concepts. Talk a little bit about valuation and appraisal requirements, as Brian has already mentioned. That's part and parcel of the non-cash giving, even with crypto, where prices are pretty easily ascertained. Talk a little bit about what the process for accepting crypto looks like, and then Paul will take us the rest of the way, going through case studies and overviews of how charitable remainder trusts work in general. So with that in mind, I think we should just dive in, because we have a few more slides than we normally do for this series. So a lot of content today, which is great. In terms of how cryptocurrency works, I think for the purpose of today's presentation, the audience should keep in mind crypto is a digital asset, but when we think about using it to fund split interest gifts like charitable gift annuities, like charitable remainder trusts, it operates in a way that is similar to public stock or equities. Not exactly the same, and we'll talk about the differences starting on this slide, but in a lot of ways, it's conceptually similar because it is a more liquid non-cash asset, and the pricing is pretty readily posted, so it's not as unknown as what you might see when we're talking about funding a charitable remainder trust or a gift annuity with something like real estate, where you really don't know what the ultimate sale price is going to be. With crypto, this is one of the big things that is really appealing about it. It trades 24 hours a day, 7 days a week, 365 days a year. For most tokens, not all, there's a lot of liquidity. Those prices, those transactions are constantly posted as they happen throughout the day. And that is, again, one way in which you can think of this as being like public stock. That transparency in terms of pricing and liquidity is very easy to think through and evaluate as part of the gift planning process. Another way that crypto is an appealing asset for these types of split interest gifts are low transaction costs and very fast transfers. Again, compared to something like real estate, where the transaction costs are quite high. Paul and I were just on a call yesterday where we both of us independently threw out a ballpark of 10% in terms of transaction costs. You have your broker's commissions, your title fees, stamp tax, transfer tax. All of those are significant expenses. None of those really apply with crypto. There are some transaction fees because the exchanges and the blockchain, they do cost money to run, but we're talking very, very minimal expenses, less than 50 basis points combined in most cases to transact crypto, to move it around, to sell it. It is often very, very cheap to move and sell crypto, which is one way that it's really appealing. So it's not just that there's liquidity, there's certainty in terms of pricing. It's also a fairly low cost, low friction option. Now, the downside of crypto, as anyone who has paid attention to this asset class and these markets for really any period of time knows, is the volatility. Even for more stable, established crypto assets like Bitcoin and Ethereum, kind of the top two cryptocurrencies, Bitcoin usually taking up at least half of overall crypto market cap. Those are still very volatile assets. That can be good, that can be very bad. You know, a 5% movement in crypto markets, whether it's an individual coin or token or the markets overall, 5% is nothing. You know, that can happen in 24 hours and be totally erased 24 hours later. Whereas, you know, if you saw that kind of movement in, you know, the stock market, that would be pretty concerning to see that kind of adjustment. With crypto, the volatility is part of it. Now, what crypto advocates and believers and owners will tell you is that all of that volatility overall has smoothed out to a significant upside, and long-term crypto holders have seen significant capital appreciation. If you talk to someone who has owned cryptocurrency for 10 or more years, you will be talking to someone who has significant embedded capital gains. These crypto owners, especially the ones who have been in it for the long haul, have usually a lot of wealth in cryptocurrency that started with a very modest investment in many cases. And that really taken together shows us what the charitable opportunity is. You know, as with many non-cash assets, when we see significant embedded capital appreciation, that does present an opportunity for a very tax efficient giving strategy, which is exactly what we have here. But we also have these other attributes of crypto, the liquidity, the transparency, the low transaction costs. Those make it look very, very appealing for charitable giving purposes, especially when we think about the volatility where donors, for whatever reasons, will have certain prices in mind and say, okay, now's the time I need to get out. I need to make my charitable move when it is at this price because we don't know where it's going to be tomorrow. So that can add a little fuel to the fire for the charitable planning conversation as well. In terms of donation activity, as I mentioned, we saw significant activity last year, and I think it's also worth mentioning what the averages have been. Our average gift size, historically $600,000, $700,000, with some 7- and 8-figure gifts, but usually 600,000, 700,000. I think for this audience, this webinar, that number is worth highlighting because that is certainly a value for a gift where you might think a discussion about a split interest charitable vehicle might make sense. If it was 60,000, 70,000, even if that was cash, we wouldn't want to really think about a charitable remainder trust. A gift annuity would work, but you know, 60,000, 70,000, you're not going to do a charitable remainder trust there. When we're talking 10 times that number, with cryptocurrency, with all the advantages I just talked about, I think not only does that clearly work for outright donations, it looks really good for charitable gift annuities and for charitable remainder trusts. What types of crypto are we talking about here? As mentioned, Bitcoin and Ethereum, those are the top 2 players. Solana had a very good year last year, and its price continues to hold. That's getting more and more established. Might see an ETF approval soon. But we really deal with a lot of different cryptocurrencies, often referred to as altcoins because they're alternatives to Bitcoin and Ethereum. And they're all usually workable with a little bit of strategy, unless we're talking about something that is very new, very, very low liquidity, not traded. But that's again kind of similar to public stock, right? If we're talking about you know, some OTC stock that trades, you know, 100 shares a day, you probably don't really want to fund that into a charitable remainder trust, and certainly not a charitable gift annuity. So same thing again for crypto. Liquidity is important, but there's a lot of liquidity there. So it usually works. And what have we seen in 2025? You know, I put this slide together late last week and it's already out of date. We've seen more gifts since then. We've seen 44 donations already this year, so we're a little more than halfway through the year. We're well over half of last year's volume with 44 donations is more than one a week, well over. And a $30 million value. I was really surprised by the value, to be honest, when I calculated that. I thought it was going to be lower, and you can see that that is still holding that average donation value, where we're still about $650,000 on average, and that's keeping in mind that we have rolled out a new offering that targets kind of lower value crypto donations. That was the subject of our January webinar. So that's really not pulling down the average as much as I thought it would, which was really interesting to me. Overall, very robust activity last year, this year. These markets are looking good. And I think it's going to continue through the end of this year because I think a lot of donors will have liquidated their positions. They'll have significant capital gains, and they will have some need for a charitable income tax deduction, which I think will further incentivize charitable giving, assuming these markets stay close to where they're at right now. They could probably even go down a little bit and still see a significant charitable activity. The appraisal part of it is a little bit different from public stock, however. Brian mentioned this. We're doing a lot of crypto appraisals. The natural question that we get from donors for probably at least half of crypto donations is, why do I need to get an appraisal if the price is easy to look up? It's clearly posted. It's even on the ticker at the top of the Wall Street Journal website for Bitcoin. Why do I need an appraisal? And why do I have to go through this extra step, this extra pain? The answer is simple. It's because the IRS doesn't care about it. The IRS does not equate a crypto exchange like Coinbase to a securities exchange like the NASDAQ. Therefore, an appraisal is still required. That means gift over $5,000, which any of the gifts that we're talking about today will be, is going to need an appraisal. Of Form 8283, which is the form for non-cash charitable contributions, needs to be filled out to claim a deduction. And the appraisal, in many cases, will need to be attached to the tax return. Appraiser needs to sign that Form 8283. The receiving charity, us, would need to sign that 8283 as well and attest to the crypto gift. This is all standard stuff for non-cash charitable giving. It's not always the most intuitive for crypto donors because they are accustomed to this type of liquidity and transparency that I've emphasized. But it is kind of critical. And the IRS has been very clear about this. They published some FAQs a few years ago that made it very, very clear that they expect an 8283 for donations of this sort. And there's really no wiggle room on that requirement. And it's actually a little more complicated for charitable remainder trusts and gift annuities, I didn't include on the slide there, but it would be true for gift annuities as well, because as anyone who works on those types of gifts knows, the value that is donated is not equal to the value of the deduction. So there are some adjustments that need to be made. So in addition to needing an appraisal, you've also got to work through these adjustments to figure out what the actual tax deduction is. So it's a little more complicated than public stock and certainly more so than cash. Finally here, cryptocurrency gift acceptance. This is very, very simplified and really is focuses more on an outright gift, but it's basically the same, whether it's an outright gift or a gift annuity or a charitable remainder trust. First, you're providing the donor with a deposit address where they're sending the crypto to. Then for security, you want to confirm that address live with the donor, make sure that there weren't any copy and paste errors and that the donor is seeing the full address, because if you drop a digit off, that's really bad. Just like getting a wrong number on wiring instructions, that's really bad. Then the donor will send a test over, just a small amount of crypto to make sure that the deposit address is actually correct and that the charity can see it land on their side. Once the charity does, confirm receipt, the donor sends over the balance, which the charity receives, and then immediately sells. It's basically going to be that same process for an outright gift and for a gift annuity. And for a charitable remainder trust, it can get a little bit different in terms of sort of custody and agency, because the charitable remainder trust is a standalone legal entity with 's own EIN. And so you have some questions about sort of who is transacting with the crypto on behalf of the charitable remainder trust. But I think Paul's going to talk about that in a little bit. But overall, conceptually, this is always how it's going to work in terms of sort of moving crypto safely and securely. It's really important because, like a wire, if you send it to the wrong place, you're going to have a hard time getting the crypto back. So again, just sort of best practices here that are pretty commonly accepted throughout the crypto industry. So that's really all there is to it. And with that, I'll hand the slides over to Paul here.
Okay, thank you, Ryan. And thank you to everyone who's joined us today. I'm excited for this conversation for several reasons, but one is because I've literally had 3 discussions about crypto-funded CRTs within the last week, actually 2 last week and 1 yesterday. Now, not every one of these is going to work out for reasons that I will share, throughout here. But I typically try to start out with just a very brief primer on CRTs, just depending on where you are in your exposure to CRTs. And we did a session in October of 2022. We also did a session in October of 2024. You can go back in the archives. It's basically the ABCs of CRTs. So in our webinar area, if you want to watch a full hour on CRTs, those are pretty good primers as well. I tried to capture in my image here what some estate planners will refer to as the Swiss Army knife, the Charitable Remainder Trust, the Swiss Army knife of charitable planning. I've even heard estate planners refer to it as the Swiss Army knife of estate planning strategies. And while I don't think I even captured all of the use cases of a CRT here, you'll see a few of them. But I think for our top topic for today, probably the most important feature of the Charitable Remainder Trust is it allows somebody who has perhaps an over concentration in a certain investment, that could be cryptocurrency, to make a donation, divest of that asset, redeploy it into a much more broader portfolio of investments, right? That's one of the features. And I see that as one of the most important features of a CRT for our crypto investors. Go ahead to the next screen, Ryan. Now, I briefly want to talk about how to introduce the CRT concept to donors. This is just kind of in general. And I'll preface that by saying that this is probably the easiest part of closing a CRT is introducing the concept. And those of you who have closed a number of CRTs, I think you understand what I mean. A lot of people can bring up the concept of a CRT, but there's a lot more involved when you get to the closure. Usually donors are going to start asking more granular questions. When they start receiving the paperwork, that's when the stakes become high and you can start to lose the donor and lose the potential CRT. To use a football metaphor, because I'm excited that we're weeks away now from football, it's kind of like, most gift planners and advisors can very easily get the ball to the red zone, right? And so in football terms, that means that you're within 20 yards of scoring a touchdown. But here's the thing, it gets harder once you get into the red zone to score a touchdown. And it's because the defense tightens up, the defensive backs aren't worried about the deep ball threat. And so it gets harder. And so that's where that's where the stakes are high as we get into that, what I call the red zone of the CRT. So how do you prepare to anticipate the types of, bumpiness that you might have during that time period? Number one is to prepare relentlessly. Read about CRTs for an hour a day. I've done that many days in my career, even when I didn't have a CRT case in front of me. I would read for fun. And number two is bring in strong planners to this process, including the donors' advisors. I have never, after being involved in now 200 CRTs plus, I've never done one alone without the help of internal partners or potentially external partners. And so, being prepared as you get into that red zone is really important. Next slide, Ryan. Now, my very first training session with Crescendo, and some of you have heard me talk about this story before, and maybe some of you experienced it personally, is that there was an acronym that Charles Schultz, founder of Crescendo, in the training session used that has stuck with me throughout my career. And Charles, in the only way that he can, got a big pen out of his pocket. This was about 2007 or so, I would say. And he get the big pen out of his pocket, and he said, I want you to remember BIC because they're the most important 3 features of a charitable remainder trust, and these features are benefits to the donor. So, Mrs. Smith, I know that you were very fortunate to invest in Apple stock, as Steve Jobs came back, and now you have a significant amount of your wealth in Apple stock. You're reluctant to sell it and pay all the taxes associated with that. So one idea that I wanted to talk to you about is this giving vehicle where you can donate your shares of Apple stock to this trust. And if we follow the rules that the IRS gives us, this trust is tax exempt. So when we sell the shares of Apple, 100% of the money is still there to be redeployed and reinvested as we see fit. Okay, that's benefit number 1. It gets better, Mrs. Smith. I know that you want more income in retirement, and that's exactly what charitable remainder trusts are designed to do, is to provide you income. By law, the minimum payout to you is going to you or to your loved ones will be 5%. And then finally, C, the charitable income, you earn a charitable income tax deduction. Now, Mrs. Smith, because you are receiving income back from the trust, the IRS gives us tables and guidance on how to forecast your charitable deduction by simply removing what we anticipate to be the present value of the payments throughout you and your loved one's lifetime. And that way we arrive at a charitable income tax deduction. So, and that you're able to use immediately upon funding the charitable remainder trust. So let's talk about crypto now a little bit in terms of CRTs. When establishing either these CRTs or CRATs, it's important to remember 2 key IRS actuarial requirements. One is the 10% remainder test, which requires the present value of that charitable interest to be at least 10%. And many of you know, if you've done CRATs, there's another one. It's the 5% probability of exhaustion test, which ensures that there's no more than a 5% chance that the trust will run out of assets. So given the typical demographics for many of our donors who have invested in crypto long-term, and not every donor fits into this demographic, but the top of the bell curve, you're going to be working with donors who are probably in their 40s or maybe at the oldest early 50s. So I was working on an illustration for a married couple, both aged 39, and they wanted a lifetime CRUT, and we couldn't get there. It's not going to pass that 10% test. So when we think about the typical demographic, and research has shown, and we don't really know, for sure, but there's somewhere around between 10 and 15% of Americans, adults, that own cryptocurrency. This ownership skews younger, it skews male, but very interestingly, it's more diverse than the general population. But that segment, the top of the bell curve, is probably going to be, your millennials, if you will. And so that's just one thing to keep in mind when you're setting up charitable remainder trust. If they want a lifetime CRUT, that the 10% test is going to be one of the first things that you have to consider. It may be very possible, we're going to talk about CGAs obviously a little bit today, but it may be possible that a deferred CGA, especially if the donor doesn't need the income for a number of years, may allow them to pass that 10% test, because there's a separate 10% test for CGAs. It may be easier for them to pass that compared to a charitable remainder trust. Just a few more things to mention on this slide. Funding a CRT with cryptocurrency can be effective, but the structure choice is also critical given crypto's potential volatility and liquidity profile. So a CRAT, for instance, for a couple reasons. Number one is if the demographics of the donor skews younger, we're not going to pass, the 5% exhaustion test, or probably the 10% remainder test if it's going to be a lifetime CRAT, right? You could possibly do a term of years. But the other is the risk of liquidity. And I'll bring back Ryan eventually to maybe add to this. But if you're going to fund a CRAT with crypto, you're probably going to be looking at the blue chips, Bitcoin, Ethereum, something that you know as a trustee that you're going to be very confident in instant liquidity, just like shares of Apple stock, for instance. When it comes to then a charitable remainder unit trust, which is more likely to be the funding mechanism, it's likely that you could set up a standard CRUT. Again, best practices would be utilizing those blue chips that we know have a high degree of liquidity. Now, Ryan is much more of a crypto expert than I am. He is exposed to all of these alternative coins, and he can maybe expound on this as we talk a little bit further. But it's very likely that we're going to want to use a flip in terms of funding a CRT with more of those alternative coins, because it could take a period of time to liquidate depending on the size of the lot that's being donated and what that volume of trading activity is for that investment. The last thing I wanted to add here is something that I've been running into as I've been talking to prospective donors who are very intrigued with this idea of funding a CRT with cryptocurrency. Is one of the first things that they ask, not every one of them, but is as soon as we transfer the crypto over to the trust, can I sell the crypto and can I trade crypto in this trust? And the answer is maybe, but most corporate trustees, most charitable organizations that serve as trustee, including DECMI, are probably not going to be interested in being involved with this. We're looking for donors who really are interested in divesting of crypto and redeploying into some other, traditional portfolio. So much so, too, that I would add that I don't think that the private foundation rules for CRTs will come into play too much with this type of transaction, unless you have some weird self-dealing situation where you have a Bitcoiner who's like a miner or something like that. But what could come into play is actually the private foundation rule called jeopardizing investments. It's one that I don't usually worry about or spend a lot of time with, but it falls right in line with the prudent investor rules that you see in other areas of the law as fiduciaries. And so, if you are going to serve as trustee to a donor who is interested in redeploying into a bunch of other different cryptocurrency, or even worse, trading on a regular basis, at that point, it's probably best to put them in a position where they can be their own self-trustee and make those decisions and consequences on their own, and either have a good CPA that can address the administration of the trust on an annual basis, or to go to one of the primary administrators that are out there, like the CTEX and the Renaissance of the world would be another alternative to that. So I just wanted to mention those things that could possibly happen. Ryan, anything to add to that?
Just one thing, really to your last point about sort of setting expectations with the donor, because a lot of them, like you said, Paul, will want to redeploy into other crypto investments and kind of trade crypto within the Charitable Remainder Trust. Still others will not even want to do anything that complicated. They'll just want to hold the crypto in the Charitable Remainder Trust. Even knowing there's a flip provision and that it's not going to pay out until that crypto is sold, they'll have it in their mind that they can just hold the crypto and the value will continue to go up, because it always has for them. That's why they're doing this. It's become so valuable. But that runs into the same problem that you just talked about, Paul. It's especially with the volatility, there are some real fiduciary issues there, I think. And when we start to have that conversation with donors, that's when we again start recommending, okay, maybe you need to self-trustee this if you're really set on that path of holding crypto inside the trust.
Great, thank you. And I just want to expound a little bit on a typical flip charitable remainder trust. Ryan, if you want to go on to the next slide. Brian, do you have any thoughts?
Yeah, just very quickly, and this has been more personal, and I shouldn't say this on a recording, but I will, because I made an idiot of myself. So Paul talked a bit about the sort of demographic skewing young. They do. I do a lot of these appraisals, and I mentioned wild guess, anecdotal, that maybe 15% or so would be sort of in the late 50s or older. So, 1 in 8-ish. And I will never forget, because of the idiot I was, that I was working with a woman, a very much older woman. I would say maybe maybe early 70s, out of Arkansas. And we were talking through sort of the appraisal that she needed. It was on Ethereum. And I literally said, I said, may I ask, how did you get involved with crypto? I said, was that like your kids or grandkids? And she, whoop, she popped me pretty good. Like, there was not a lot of pause there. She's like, I know about this. I'm very much in tech. I found this interesting. I bought in at like 2000 and maybe 15 or 16, so it wasn't crazy early, but it was pretty early. And she said, no, I have multiple cryptos. So that was a very good lesson I learned, appropriately so, through a mispresumption. But a bigger point was, as I was working with her, and she'd actually given this to her church. It was about $740,000 of Ethereum to her church. And I said, may I ask, like, what was the largest amount that you ever gave to your church before? And she said, oh, it was like maybe $10,000. And she said, to me, that was just a huge gift. And I said, well, this is a much bigger gift than 10,000. And she said, yes, but I only invested 10,000. And she said, if all of you have read The Cash is Not King, Dr. Russell James, The Windfall Effect, and I've never had it as viscerally explained to me, where she said, I invested this 10,000. I thought I was going to lose it all. Just risk capital, whatever, kind of a lottery ticket. It grew to 740,000 in her mind, which was very sharp and very smart. In her mind, that was $10,000. That's what she was giving to her church. And I'll bet you a ton of money if she converted that Ethereum of 700,000 plus, which she could in about 4 seconds. And then if the church asked her, please write a check to us for 740,000, she would convulse on the ground. I could feel it. But to her mentally, it was a lottery ticket that hit, lots of capital gain, and she's acting as though she was still giving $10,000 to her church. So I just think it's important to understand the psyche beyond crypto. Same things happens with real estate. Same things happens in a pretty big way with private stock. But in crypto in particular, this sort of windfall effect, I think, is very powerful. And it also, again, there are a number of these that are older than the 30-year-old sort of in the back of the Uber trading on Robinhood that I think is the perception.
That's a great point, Brian. And, it just made me think of another referral that you sent me of this gentleman who's 71 years old. And he originally reached out to us about funding a CRT with Bitcoin. And then he changed his mind and said, I'm interested. I have a $4 million apartment complex that I'm actually early in the negotiation of. Might that work for a CRT? Yes, it would. So now I'm discussing with this gentleman funding the apartment complex in this CRT. It'll be a flip CRT like what you see on your screen here. But then he asked, well, can I add Bitcoin to this CRT, years down the road? I said, absolutely. We will make sure that one of the provisions in your CRT is it allows for additional contributions, which, as you know, you can't do for a CRT, but you can do for a CRT. I'll just go through this super quick. Because I think it'll be better illustrated in our case study instead of right here. But again, when you're dealing with an asset that depending on the confidence level that you have and the liquidity of it, you may not need this flip provision. You can see in my example here, I'm using Bitcoin. So I think it's pretty safe to say that we could probably fund a standard CRT with Bitcoin and be just fine. But when we get to the case study, we'll see that there's a need. If you're funding this with less liquid altcoins, you may want to very seriously consider this flip. The other thing is that many of these donors, if they do skew younger, they may want the flip may not be the sale of the Bitcoin, but the flip may be when they reach a certain age. So this young lady is probably a millennial in my image here, and maybe she doesn't want the income for 15 more years. So that would be her flip trigger in this instance. Okay, go ahead to the next slide, Brian or Ryan, so we can talk some case studies here. So we just have two case studies, and I think they will give you a pretty good idea of how we address these. We'll start with the charitable gift annuity, Ryan. So you've got Derek and Carrie. They were early investors in both Bitcoin and Ethereum, which is typically the types of donors that you're going to encounter. And while at the National Gift Annuity Foundation, we can begin immediate annuities at age 55, Derek and Carrie are very close to that age. But again, they're working. They're long-term investors in crypto. And really what they're trying to do is they're trying to find a way to divest of some crypto because they think that it's at a pretty high valuation, but also they're trying to build reliable income for their future and do so in a way that is very tax efficient. So very similar to a CRT, obviously a charitable gift annuity produces a lot of the same tax results. So in this case, Derek and Carrie go ahead, they donate to National Gift Annuity Foundation, or could be to your charity, these blue chip coins. And we should be able to value the contract of the CGA based on the appraisal, because again, we've reached this point where you don't see too much volatility in these two blue chip coins, especially. But one thing that we do at Charitable Solutions and through the National Gift Annuity Foundation is when we are funding a non-cash asset into a charitable gift annuity, and I do a lot of these with real estate, how we typically approach the contract is that the contract will read that the donor long-term will receive the lesser of the net proceeds or the appraised value. It allows us to create an ascertainable value in the contract, which is absolutely necessary from a legal standpoint, but yet it allows us to mitigate our risk in dealing with volatility. So if we were using more of the alternative coins, we might want to weave that provision into our CGA contract. Ryan, any thoughts or anything to add there?
Yeah, I think the adjustment is probably most appropriate for and we were talking about this just before we launched the webinar. A case like one I'm working on right now, where it's not your blue chip, like the terminology you use, which is really appropriate for Bitcoin and Ethereum. Nor is it the really thinly traded token that's probably not going to work for this type of vehicle at all. It's somewhere in the middle, and the liquidity is there, but it's just not something you're going to be able to trade through in a day or even 2 days. So in that case, you're probably looking at a slower wind down of the position, and that's where I think that sort of adjustment is much more appropriate, because you just don't know what the average final sale price is going to be when you start the trade. And it could be a week or 2 weeks or maybe even longer before the sale is actually complete. And that's an opportunity for a lot of price movement in the crypto world.
It's a great point. And I think that's a good segue actually to our second case study, Ryan. And to Brian's point earlier, don't judge a book by its cover, right? So we've got Diana here, who is investing in alternative, well, these may not even be considered alternative coins. They are to me, because I'm not a crypto aficionado by any means yet. But they are, these don't have the same liquidity as your blue chips. And so, and also Diana has a significant amount invested in crypto here. She wants to fund a CRT with $1 million worth of her crypto, but she also wants to use 5 different coins. And so in that case, when you're dealing with that much uncertainty, it's probably, and we're also August now in the year, it makes complete sense to me, that we're more than halfway through the year just to propose a flip. And that flip provision in the Charitable Remainder Trust will be based on the sale of all of the alternative coins. So that way, as a trustee, you're not panicking because maybe 3 out of the 5 are pretty liquid and 2 out of the 5 you're struggling with. And this also proves the point too that when you're confronted with this type of gift scenario, you really should be working with somebody who has had broad exposure to crypto, like Ryan Raffin here, because as an institution, if this is your first time funding a CRT with crypto and it's the alternative coins, you really should be, you need not only the tax and structural guidance of setting up a CRT, but also the trading strategy that goes into this type, to handling the disposition of these types of assets. So other than that, pretty straightforward type of charitable remainder trust, nothing to be intimidated by, because again, you can fund a charitable remainder trust with pretty much any asset. And we've been fortunate now in the tax code for 30 years, almost 30 years, to be able to have this flip provision. So it gives trustees a lot more flexibility in terms of the liquidity of the assets. Go ahead, Ryan. I just wanted to mention that we do partner with charities and advisors across the country on CRTs, and we do that through 3 different models. Ryan, if you want to go to the next slide. So the first model we call the pre-flip model, and this works really well for larger charitable institutions that regularly serve as trustee of charitable trusts, particularly CRTs, and that they probably have like a good financial institution that helps them navigate that. So we do this a lot, where the charity is not interested in serving as a trustee. On the front end, it could be real estate, it could be a closely held business asset, it could be crypto, and they're be much happier after that asset is liquidated and and we're ready to convert to a standard CRT. Then we can resign as trustee, charity takes over, we send the money to whatever RIA that you use. Okay, that's service number 1. The trust only model is where Decami is in a position to serve as long-term trustee of a charitable remainder trust, and we don't invest the underlying funds. So the donor can hire their own financial advisor, RIA, to manage those underlying assets. And then third is turnkey, hence the name. It's everything that you have in the middle one, the trust only model, but we also do have model portfolios that we use. Pretty boring model portfolios nevertheless, but we provide that full turnkey process for setting up CRTs. And so we've got a few minutes, Ryan, yet for Q&A, and I just wanted to thank you all for joining us. I also wanted to get a plug in for the Gift Planners Workstation and the tools that we've been developing in partnership with Charitable Solutions with my separate company, Plan Giving Interactive. You can go to estategiftplanning.com, test drive Frank, who is the Plan Giving AI companion to help you research pretty much everything plan giving, whether you're a professional advisor or a plan giving specialist. So Ryan, that's pretty much all I have for today. We've got a couple minutes if we want to attempt to answer some questions.
Yeah, let me see if I can pull them up. I'm having a little bit of trouble getting those questions pulled up. Oh, there we go.
I think I've been answering them too fast. That's probably my fault.
Yeah.
Looks like there's some coming in there. Definitely a good time for any questions for any component of this. And I would super lean into this Frank Gift Planners Workstation tool. Just so you guys know, he's got the illustrations coming soon. So a lot of what we're talking about here could be a prompt within this AI tool that basically says, I've got $10,000 basis and $1 million of Bitcoin. I'm considering a charitable remainder trust, and I'm 59 years old, or and that would actually create a wonderful sort of summary ChatGPT like output with illustrations, and then likely very soon we'll include sort of the calculations as well. So yeah, so got some questions coming in maybe.
Yeah. One thing just to add on, there was the question from Dana about the lesser of language, and that gets very complicated as you pointed out in your response, and sort of how that adjustment works And one thing I would emphasize for the crypto context specifically is because of the liquidity, we're probably going to be able to avoid that with most crypto funded CGAs. Unless we're talking about cryptocurrency where there is a little bit of a volume limitation. But in a case like that, I think we'd probably all be in agreement. Probably that's a donor we want to encourage to think about a charitable remainder trust rather than a gift annuity anyways. So, if it's a gift annuity funded with crypto, that kind of adjustment is probably not going to be needed in the same way that it might be with real estate in particular, where it's pretty essential, I think, in my opinion. But yeah, just wanted to kind of tie that to the crypto context and just say, it's very complicated, certainly with crypto. Thankfully, it's probably not going to be needed in most cases.
Real estate and S corp are typically the two that it comes up, or there's other kind of UBIT assets otherwise used to be funding CGAs as an example. One other thing too, I think maybe practically, maybe we can discuss this. You sort of mentioned the agency role, Paul, before. And so one thing that I think many of you may know is that even if you're creating an institutional crypto wallet, that every single donor, and I mean every single donor, thinks that that's a 3.5 minute process that you can do on your iPhone with a Coinbase widget, like every single one. And then you go through the process of what typically takes 3 to 4 months, at least everything that I'm hearing, to be able to create that institutional account, totally different than retail, and an institutional account, in many cases requiring, because you've got obviously governing members and sort of control persons, et cetera, sort of providing all of their social security numbers, addresses, birth dates for all of your board members, which makes them super comfortable. And then you're having to email that randomly to some kind of email box and so on. In many cases, that is still required if it's a CRT or not. It's the same thing. It's still an institutional account. The appraisals that I have done for crypto funded CRTs, and they're a fair number that I've done, one of the biggest issues they have is how do we set these up once we get the charitable remainder trust set up, there's sort of that level of lift as Paul mentioned. Then you've got the EIN number, then you're contacting the various exchanges. And that is a lot more difficult than people think that it is, because many will not even allow a trust in this case to create sort of its own wallet. Some do, but very much the sort of minority, all things being equal. So just know that there's some practical considerations and logistical considerations. And that's where we have basically said is we're comfortable sort of doing that through our institutional wallet if we are the trustee, sort of getting back to the same CRT structure. And then once that's sort of sold within our wallet, so in essence deemed agent, then would be able to make that sort of transfer over. So it's a little bit different than what you would certainly be doing, and I think much more efficient than if each donor was creating their individual CRT, their own individual wallet, and so on. That just, again, that's a bit of a road to do that, frankly. But Paul,
Brian, that's a
comments
great
on that?
point. No, I just would add that's a great point, Brian. And we will add even more thoughts to that, I think, on Thursday. But I can't even imagine a donor trying to reach out to Coinbase, Kraken, or whoever else and asking them, now, how do I set up a charitable remainder trust account with you all? That's going to be a process. And so we
Right.
think, we've got a pretty good way of mitigating, that. And there's a lot of fees that can be involved as well. We've got the economies of scale where I think we can really do that much more efficiently now that we have some guidance, Brian, to do it this way.
Yeah, and a great question came up. It's a really good question. Difference in funding procedurally from let's say a Coinbase account, similar, instead of a cold storage, wallet as an example, Razor or whatever. So how,
Yeah.
I guess maybe do you guys want to maybe speak to that question? That's a great question.
Yeah, I saw this as well. This is a really good question. I'm glad it was asked. So in theory, no difference between what's needed to move the crypto from wherever it's held, an exchange account or a wallet that's in cold storage, to the Charitable Remainder Trusts account, it's still that same process of moving it to the deposit address and going through the tests and the confirmations, all that. Practically speaking, and I've run into this many times, what donors will run into, and it can be an unpleasant surprise, particularly at year end, are withdrawal limitations within their own account if it's on Coinbase or Robinhood, or sometimes there are security features like whitelisting or third-party authorizations. All of those can prevent an easy movement of coins from the donor's account if it's on that sort of exchange, Coinbase, Robinhood, really any kind of third-party custodian. And Robinhood in particular is challenging here because their limitations on withdrawals are quite low. I think you would have a hard time actually funding one of these vehicles if you had a significant amount of crypto on Robinhood. Just moving it off of Robinhood as a platform is not easy. So that is something to keep in mind if you hear that your donor is using an exchange or a third-party custodian. You want to make sure that they can actually move the coins off of that platform and they understand what that process is, because it is often much easier said than done because of these security features.
Exactly. Well, I think we're right at time. Paul, Ryan, fantastic job per usual. Very, very good job. Great questions, by the way. And again, we'll be able to take the video, take the questions from today and the answers, and then the same for from Thursday. We'll then be posting next week. So everybody, I hope this was helpful, good information. We can help you capture more gifts than otherwise you thought possible, or working with a crypto donor that might call you in 15 minutes. Like, wait a minute, this can be done. So life income gifts certainly can be funded with crypto, and it's happening now. So thank you all very, very much, and I hope it was helpful. Bye-bye.
Thank you.
Thanks all.